welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Stephen Yu, Fund Manager of the Blue Whale Growth Fund. Stephen, good to see you today. So Stephen, it's a global fund. One of the ways that investors can compare performance is to look at your performance against the MSCI World Index. Now, over the past couple of years, in 2023 and 2024, global stock market returns have been concentrated. There's been a small number of winners. In particular, the biggest US technology stocks have performed well, the so-called Magnificent Seven. Do you think in the short term there's a risk that this is a potential bubble that may pop?
It's a very interesting question because obviously we are bottom-up stock pickers, so we only pick 25 stocks in our portfolio. And if you look at the Mag 7, we only have two stocks, just about 2.5 stocks, which are Nvidia, Meta, and we are reducing our position in Microsoft, so I would consider as a half position. So we have probably taken a view that we don't like the other stocks, like for example, Alphabet, Apple, or even Tesla, if you consider that as a Mag 7, that we have some specific concerns about those companies. But I think what had happened in the last 2 years or so, I would say that some of that rise or money that have gone into the big tech is because of the rise of the passive ETF. Because if you want to take a view on technology companies or AI, you just want to buy a basket of stocks, right? And obviously a lot of the basket of stocks would encompass some of these very large companies per se. So I think that's a lot of money that's gone into names that we do not think is justified. And of course, sometimes it puzzles us. Like for example, Alphabet's, like I still have a very negative view in terms of the growth trajectory from here on the back of generative AI is going to be a disruptor to its business model. But of course, you look at the share price, it's still done very well. So then who is right? Is that the market or maybe us? So I don't disagree with you that at some point there's going to be some shakeout in terms of exactly what AI means. And of course, we took the view that we are more pro AI infrastructure versus AI applications. And if you look at the Mag 7 part, Nvidia, all of them would be AI applications company rather than AI infrastructure. So I think in time we will be able to see which narrative is correct.
So let's talk through the two positions you still have plenty of conviction in. Do their current valuations reflect their future earnings potential? Or in other words, are you comfortable with the current valuations?
Yeah, I think they are very different businesses, so I need to probably expand that a little bit. So Nvidia's valuation, I think the interesting thing about Nvidia is a lot of people probably who haven't done the work on Nvidia would be saying, oh, Nvidia is trading in a bubbly territory, looking at the share price, how is it possible a company have gone up 200, 300% over a short space of time? But if you look at the earnings that Nvidia has delivered in the last 2-3 years, that has gone up even higher. So compared to the time that when we first invested into Nvidia in 2021, while Nvidia's market cap was only at about $500 billion, that the valuation at the time was a lot more expensive than today. So Nvidia today, even at the $3.5 trillion market cap, is a lot cheaper compared to 2021. So this is something to note, that the valuation that Nvidia is trading at, let's say using 12 months consensus number, is only over 35 times, just about. And what 30-ish times earnings means is if you look at Apple doesn't grow 50 to 100%. Apple's valuation is at about 30 times earnings. But what it means is because Apple's business is relatively sticky in terms of the customer base, the ecosystem, it means that the quality would then reflect some of the valuation. This is something that would expect Nvidia to trend towards. So in time, Nvidia does not need to repeat the growth trajectory they have delivered in the last 2-3 years. Going into the next couple of years, they just need to deliver some healthy growth, which that's something that we believe in. And I think the market valuation already reflected that today, because the valuation of Nvidia is only trading at over 30 times earnings. And then on the other hand, Meta, we do like. I think if you ask me to pick one AI applications company that is going to be the ultimate winners, or at least have the highest potential to deliver return on investment for shareholders, we would pick Meta, just because majority of that investment is going into their internal workflow, how they are going to probably analyze our data a lot more through through Instagram, Facebook, maybe a bit of WhatsApp. It's quite controversial. And I think in time they will be able to deliver us personalized advertisement. So in terms of return on investment, because they're very data heavy, they have like 3 billion users in the world, 50% of the world population. That's going to be very interesting. I think if you think about what generative AI means, it's all about data.
The fund has around 40 to 45% in technology. Could you break down that exposure? As I know there are certain companies you own that you think could be classified in another sector.
Yeah, so this is interesting. So if I go back in time, so on average over the last 7 years or so, we have on average 40% exposure to technology companies. But what has been interesting is the composition of that mix is completely different today versus 7 years ago. I mean, 7 years ago, we were heavily exposed to digital transformation opportunities like digital advertising, software, digital payments, cloud, and some others. And today, it's mostly AI. But the one bit that is very debatable, and of course, we would have a slightly different view, but at the moment it's categorized under technology buckets, is semiconductor equipment companies. So we like both applied materials and Lam Research. So very similar to ASML, which we used to own, that we no longer have today, is they are the pick and shuffle in terms of how the world operates on a day-to-day basis, right? If you need semiconductors, which is in almost every devices that we can get our hands on today, then you need that semiconductor to be produced, but using some of this equipment. So all this equipment will go into the foundries to produce semiconductors. So then if you think about like exactly what that is, it means that they're probably more of an industrial company rather than technology company. Of course, a lot of things is technology, but could we actually separate technology from our day-to-day today? Like, you can't do that anymore. It's like truly embedded, not just from a consumer perspective, at the same time businesses perspective, or even though like if you are industrial businesses, you would have a lot of technology, the robots, the automation in there. So then you can easily categorize semiconductor equipment companies being industrials rather than technology. But I think that is something that we're not worried about, but it might be a bit misleading when you look at, technology, there's a lot, and then we haven't probably got enough on industrials, and which some other other manager might have. Yep.
And do you think about the overall exposure? I mean, you mentioned some companies could be classed as in other sectors rather than technology, but given you have around 40 to 45% in technology, is there like an upper limit that you think actually I wouldn't want to go higher than that?
I think we are very pragmatic on that note. I think the way that we run the fund is we want to invest into the best company that can outperform over the next coming years. I think so far where you find those companies would be mostly in the technology bucket, right? You would struggle, I think most active managers would struggle if you decided that I do not want to have technology in my fund, or I have a very small exposure in the fund, and you would think maybe the likes of consumer staples is going to do better than the Max 7. I think that is a very probably a detrimental mistake that you can make. And then also, I think people need to acknowledge that maybe just over 7 years ago, the technology component of the market would be probably at less than 20%. Because like market cap of Microsoft was only at about $500 billion. Today it's $3 trillion, and then you got a few more that are in the trillions bucket, right, the Max 7. And so if you look at the composition of the index, which is something as an active manager we need to outperform, part of the passive, then you need to take into account like what is the composition of the index. And I think at the moment you would probably say that we are just about in line with the market, because technology component of the market has gone a lot bigger over time. Of course, I mean, that's not how we manage money, but then is that a stopping point? We don't know, because like if this continue, if AI is really going to change the world, then I think that certain businesses are going to disappear on the back of that. It's just similar to how digital transformation have taken place in terms of killing a lot of high street retailers, that we are now spending a lot more time in the digital world versus the physical world before the pandemic. So that could be a similar repeat of that in a very different trajectory. So then you need to be very careful as an investor to pick the right sectors or company that would actually do well under this new era. Given
that you can invest globally, is the UK a stock market that is interesting you at the moment in terms of the investment opportunities? A lot of commentators have been talking up the UK market due to the fact that it's trading on lower valuations than its history and the share prices are cheaper than other markets such as the US. So do you have any exposure to the UK?
We have some. So we started off with Flutter, was a UK company, and obviously if you follow Flutter, that they have now re-headquartered it to the US, so they're going to drop out from the FTSE index, and we like Flutter in terms of the US sports gaming market. And at the same time, we have a very small position or trying to build conviction in LSEG Group, so London Stock Exchange Group, and there's a lot of data data is part of the business after they acquired Refinitiv a few years ago. So 50% of the business is in data analytics and the terminals. And if you look at the IPO or the London Stock Exchange business in itself, is only like 5% of the business. But of course, we need to see how this is going to play out, because they are adopting certain AI technology, working with Microsoft to enhance some of the capabilities. But I think the way that I think investors should think about how you want to allocate money, whether it's to UK companies, American companies, or Asian companies, is like you need to ask yourself, what's your objective? Like our objective here is to maximize the outperformance potential. We're trying to maximize your investment return. And then, of course, UK being very undervalued, that has been undervalued for I don't know how many years already. I started off my career as a UK fund manager. And then you can talk about different strategies, like growth strategy, value strategy, quality strategy. It doesn't really matter, because ultimately, if you believe UK companies can maximize your returns, you buy UK companies. That's not our view. And then our view is actually we want to buy the American technology company that's maximizing the return potential. And that's how we have managed to recover quite strongly on the back of 2022 over the last 2 years. I don't think we can do that investing into UK companies. But of course, things can change. So then I think you need to be quite open-minded when things are developing. And obviously, we welcome more opportunity in the UK. But at the moment, I think it's a lot more difficult to find company that could be exposed to certain mega trends, which is then you are going to become a lot bigger than before. And the last point I would make is, like, if you just use NVIDIA as a proxy, 2 years ago, they were only making about $30 billion top line. And this year, they're making $150 billion as a one single company. You think about the NHS in the UK, the budget is about 100-something billion, and we are all short of money. But then you have this company suddenly coming from nowhere. They're making $120 billion more today. So you want to invest into this kind of company rather than some company that maybe there's just not a lot of growth opportunity.
And finally, we always ask whether fund managers have skin in the game, but it's one I've asked you before. So I'll slightly rephrase and ask, do you regularly invest in your own fund?
So from my perspective, I only invest into the Blue Whale Growth Fund because I run it. I have an inside track. I have probably more conviction than most other people from the outside, and I don't invest in other funds. So that is what I have done for myself. But in terms of ongoing investment, the Blue Whale Capital Partnership, so the company in itself, have decided to invest just about £120,000 a year into the fund strategy. And we started that exercise back in 2022, and in 2022, of course, that's a big valuation reset in terms of the NAV, the valuation. And then what we did at the time was we decided to spread out the investment across a 12-month period through like a pound cost averaging exercise. So 10K a month over that 12-month period until last year. And that strategy have done very well for us, and now the profit is now up more than 50% based on our average price into that 12-month period. So this year, what we have done with an additional £120,000 is we decided to seize the opportunity during the summer. There was a bit of reset in the market in terms of our holdings in valuation terms. So we have invested another £120,000 over the summer this year as a 2024 investment. And of course, if you follow the exercise, which we have that on our fact sheet on our website, that investment has also gone up a few percent over the last few months already. So next year we're going to do it again. So this is like an ongoing commitment just to take investors' hand through the journey, like how you can deploy capital. And I think different strategy work different time, and of course, like you can do an ongoing monthly contribution. But I think at some point you might want to deploy more capital just because like you get a better price in terms of what happened in the market that is not related to the company fundamentals.
Stephen, thank you for your time today. So that's it for our latest insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment. If you like the video, hit that like button, and you can also hit the subscribe button for more future Fund Manager videos. And hopefully I'll see you again next time.